Okay, so picture this. The year is 2026.
Right.
Almost everything you watch, everything you listen to, and, well, everything you read just lives on a server farm somewhere out in the desert.
Yeah, just beamed directly to a piece of glass in your pocket.
Exactly. I mean, you probably haven't seen a CD player in a new car in, what, well over a decade?
Oh, easily.
Yeah.
I don't think my laptop even has a disk drive anymore.
Mine definitely doesn't. And it's wild to think about, but there are teenagers driving right now who have literally never physically inserted a disk into a machine.
It's true. It's a totally foreign concept to them.
Right. So keeping all of that in mind, I need to understand why one single wholesale distribution company just reported selling $39 million worth of compact discs in 3 months.
I mean, it sounds like a typo in the earnings report when you first look at it, doesn't it?
It really does.
You see that figure, and it's sitting right alongside $99 million in vinyl sales for the exact same quarter.
Yeah.
And your immediate instinct is to check the date.
Yeah, like, did I accidentally pull a PDF from 1999?
Right, exactly. You think you're time traveling.
I genuinely did that. I refreshed the whole SEC database just to be sure. But no, this is the Q3 2026 earnings call transcript for Alliance Entertainment.
Ticker symbol AENT.
Yep, AENT. And the numbers are completely real. They saw a 90% year-over-year quarterly increase in CD sales. 90%.
Which is just staggering.
So today, our mission for this deep dive is to pull this transcript apart. We're going to figure out how an industry that the entire tech world completely wrote off, like a terminal patient, is actually experiencing this massive, highly profitable renaissance.
And to do that, we really have to fundamentally change the premise of what we're looking at here.
Okay, let's unpack this, because if I'm a casual observer or even just a retail investor looking at trends, I might write off a spike in vinyl as just, a niche hipster thing.
Right, like something just happening in a few indie record stores in Brooklyn or Portland.
Exactly. But I want to lay out the raw financial data to prove to everyone listening that this is not a localized quirk. This is a massive systemic revenue driver.
It really is. The scale is what changes the conversation.
So in Q3 of 2026, Alliance reported net revenue of $258 million. And that represents a 21% increase year over year.
And putting that into the context of wholesale distribution is so critical. I mean, a 21% top-line growth figure.
Yeah.
That is something you expect from a nimble early-stage software company, not a mature logistics company moving physical pallets of plastic and cardboard across the country.
Right, because Alliance is essentially the central nervous system for pop culture retail.
That's a great way to put it. When an independent game store or a comic shop or even a massive big box retailer needs specialized entertainment inventory, Alliance is the infrastructure. They are the ones routing those products to the shelf.
So generating a fifth more revenue from that massive baseline in a single year, that indicates a real structural change in retail demand, not just a lucky quarter.
No, definitely not a fluke. And what's fascinating here is that the profitability metrics are even more striking than the revenue.
Oh, for sure. Their net income grew 22% to $2.3 million, and their adjusted EBITDA hit $5.1 million for the quarter.
But we need to look at the longer timeline to see the real story. Because if you look at the first 9 months of their fiscal 2026.
Okay, let's look at the year to date.
Right, the year-to-date net income is actually up 78%. And EBITDA is up 47% to $35.7 million.
Wait, 78% net income growth.
Yeah. And I want to pause on those year-to-date figures because the disparity between their revenue growth and their profit growth reveals their entire business strategy.
How so?
Well, over those first 9 months, overall revenue only grew 5%. Yet, like you just noted, net income jumped 78%.
Okay, yeah, the math there is wild.
Right. In the distribution business, when profits outpace top-line sales by that kind of multiple, it means you are experiencing serious margin expansion.
You're making way more money per item you sell.
Exactly. You aren't just selling more volume. You are fundamentally changing the mix of what you sell. They are transitioning away from low-margin, commoditized items.
And leaning heavily into high-margin premium items.
Precisely. While maintaining really strict operational discipline.
See, I was staring at this part of the transcript for like 10 minutes trying to figure out how they pull off that mix improvement. And it always comes back to the physical media.
It's the core driver.
Let's break down those category numbers for you guys listening. So vinyl revenue was up 15% to $99 million in the quarter.
Huge number.
Physical movies, so your DVDs, Blu-rays, 4K Ultra HD, grew 5% to $61 million.
Which is a turnaround in itself.
Right. And then we have the CDs, up 90% to $39 million. And look, I hear the explanation about collectibles, but I have to push back a little on the sheer volume here.
Go for it.
Who is buying $39 million worth of CDs in 2026? I mean, a vinyl record is large, it has huge artwork, it feels like a collector's item.
It has a real presence, yeah.
Exactly. But a CD is just this small piece of polycarbonate plastic inside a fragile jewel case that shatters if you look at it wrong.
I'd actually push back on the idea that the CD lacks collectible appeal, particularly for younger demographics.
Really, even with the cheap plastic cases.
Well, it's not just standard jewel cases anymore.
Yeah.
But to put the actual unit volume into perspective, the CEO, Jeff Walker, noted on the call that over the full year of 2025, Alliance sold 16.8 million vinyl units.
Wow.
And 13.5 million CDs. So this is broad-based, sustained volume. It's not driven by one artist dropping a special edition.
So it's a real behavioral shift.
Exactly. What we always assume about technological progress is that it's this one-way street. A superior, more convenient format arrives, like Spotify or Apple Music.
Right. And the old format is just rendered obsolete and dies.
That's the assumption. But that assumes the consumer is only seeking convenience.
Which brings us to the psychology of this entire phenomenon. Because during the earnings call, management hammered this point repeatedly.
It's central to their thesis.
The consumer buying a Taylor Swift CD or a BTS CD or a Bruno Mars vinyl record today is not buying it because they lack a streaming subscription.
No, the audio data on that disc is completely redundant.
Yeah, they already have it in their pocket for free.
Exactly. The transaction has nothing to do with accessing the audio. The structural shift here is that physical media has transitioned into a pure identity marker.
So what does this all mean for retail as a whole?
Well, look at the big players. Target is dramatically increasing its investments in pop culture aisles. GameStop is relying more and more on collectibles to offset digital game downloads.
Because you can't display a digital download on your bedroom wall.
Exactly. The entire retail ecosystem is pivoting because they realize the consumer is seeking a tangible connection to a brand or an artist that a digital file just simply cannot provide.
You know, it reminds me of the psychology of buying a souvenir at a concert.
Oh, that's a perfect analogy.
Right. Like, if you go see your favorite band, you might spend $45 on a tour t-shirt. You don't buy that shirt because you have an urgent need for clothing to protect you from the elements.
You buy it to prove you were there.
Yes. You buy it to signal to other people that you belong to that specific fandom tribe. And looking at the Alliance data, it seems the CD and the vinyl record have just become the modern equivalent of the concert tee.
And you might never even break the shrink wrap.
Literally, you just display it on your shelf.
That analogy holds up perfectly when you look at how the music industry is packaging these items today. They aren't just selling a jewel case with a disc anymore.
What are they doing instead?
They are selling these elaborate digipacks with lyric booklets, fold-out posters, and exclusive Polaroids.
Oh, like the K-pop model.
Exactly. The packaging is the product. And this psychology extends directly into the physical movie market, too, which Alliance is capitalizing on heavily.
Right, the DVD numbers. I was shocked by that. For well over a decade, DVD and Blu-ray sales were in a steep, seemingly terminal decline.
Oh, it was a bloodbath for years.
But the management team noted a fascinating inflection point on this call. The rate of decline is shrinking.
Yes. They believe they are seeing a bottoming out of the physical movie market.
I found that detail staggering. The idea that DVDs might actually hit a floor and start behaving the way CDs and vinyl are behaving right now.
It speaks to a growing consumer anxiety about digital ownership.
Oh man, the streaming anxiety is real.
It is. I mean, we've seen numerous high-profile incidents over the last few years where streaming platforms have simply removed content for tax write-offs.
Right, entire shows just wiped from existence.
Or digital storefronts have lost licensing rights, meaning movies that consumers supposedly bought suddenly vanished from their digital library.
Which is so frustrating because you don't actually own a digital movie, you own a revocable conditional license to view it.
Which fundamentally changes the value proposition.
It does, it really does.
And collectors, film enthusiasts, anime fans, they're beginning to treat physical movies, particularly premium formats like 4K Ultra HD and special edition steelbooks as library status symbols.
They want the security of an offline hard copy.
That feeling of permanence, knowing that an algorithm or a corporate merger cannot delete your favorite film from your shelf, that is what they are paying for.
And Alliance is just capturing the revenue from this cultural desire for permanence.
Exactly.
But, the desire for permanence makes sense. Understanding the psychology of the collector, though, is only the foundational layer of Alliance's business.
Right, that's just the baseline.
The truly compelling part of this earnings call, at least from an operational standpoint, is how they actively manipulate that psychology to maximize profitability.
This is where it gets really smart.
They don't just passively fill orders, they engineer scarcity.
And engineered scarcity is the absolute core engine of the modern collectibles market. I mean, if a product is ubiquitous, its perceived value drops to its functional value.
And as we just established, the functional value of a CD or a classic toy is near zero.
Exactly. The value is entirely derived from its rarity.
And the clearest case study from the call is how they handle Record Store Day. Alliance shipped over 700,000 units to independent retailers for the latest Record Store Day.
Which management highlighted as their largest one ever.
Right. But the real masterclass in scarcity involves their own proprietary brand initiative called Handmade by Robots.
This is a vital strategic pivot for Alliance that we really need to highlight. Historically, they are a distributor, right? Moving other companies' products.
Yes, just the middleman.
But Handmade by Robots is an IP that Alliance owns outright. They manufacture these collectible vinyl figures that are molded to look as if they are knitted or crocheted.
It's a very distinct aesthetic.
Very unique.
So for this massive Record Store Day, Alliance released limited edition, Handmade by Robots figures of Ozzy Osbourne and Hello Kitty.
Two massive fan bases.
Oh, huge. And the math they shared on the call is where things get really intense. They received over 6,000 orders from independent record stores who wanted these specific figures to sell on the day.
Demand was off the charts.
But Alliance intentionally manufactured and allocated only 2,000 units of each.
They utilized deliberate, blind allocations.
Explain how that works for someone who doesn't know wholesale.
Sure. So a store might order 20 units, thinking they'll get 20, and Alliance would just send them 4.
Wow. And the result of that was entirely predictable. The figures sold out instantly at retail, and an explosive secondary market materialized within hours.
It was immediate.
These figures, which carry a retail price of around $20 or $25, were immediately flipping on eBay and other secondary marketplaces for around $75.
A huge markup.
Now, looking at this strictly as a business operator, I have to ask, if you are the CEO, and you have 6,000 guaranteed cash-in-hand purchase orders from retailers begging for inventory, why do you restrict production to 2,000? Aren't you just actively leaving tens of thousands of dollars of gross profit on the table?
It requires immense discipline to leave that cash on the table. It really does. But it is the classic dilemma of short-term revenue versus long-term brand equity.
Okay, let's play out the alternative scenario. Suppose Alliance fulfills all 6,000 orders.
Right. The market is saturated. Every consumer who casually wants an Ozzy Osbourne figure buys one.
The items sit on the shelves for a few weeks.
And the perception of rarity completely evaporates.
And more crucially, the secondary market value stays flat, or maybe even drops below retail.
Exactly. And once that secondary market premium vanishes, the collectible aura of the entire Handmade by Robots brand is severely damaged.
So by heavily restricting the supply to, a third of the actual demand, Alliance is playing a highly sophisticated psychological game.
With both the B2B retailer and the end consumer, they are essentially training the market.
Training them how?
The independent record store owner learns a harsh lesson. They think, I must pre-order everything Alliance announces the minute the catalog drops, because if I hesitate, I will be allocated out of the hottest items.
It creates institutional FOMO. Fear of missing out, but at a corporate level.
It absolutely does. And the end consumer learns a similar lesson. They realize, if I ever see a Handmade by Robots figure in the wild, I cannot wait until tomorrow to buy it.
I have to buy it on the spot.
Because it will be gone, and I refuse to pay a 300% markup on eBay.
Right. So by sacrificing a few $1,000s in immediate wholesale revenue on one specific Hello Kitty figure, Alliance is minting a brand reputation that ensures their products will instantly sell out for the next decade.
It's the exact same playbook Nike used for years with Jordan sneaker drops.
Oh, that's so true.
But they're applying it to B2B wholesale distribution of pop culture toys.
But this engineered scarcity creates a massive secondary problem.
The trust issue.
Yes. The minute you successfully train the market that your items are rare and they begin commanding real money on the secondary market, you introduce two massive friction points for collectors.
Counterfeits and condition.
Exactly. The flood of fakes and an absolute obsession over the physical condition of the item.
You see this in any asset class that appreciates.
Right.
Trust becomes the primary bottleneck to liquidity.
If someone is paying hundreds of dollars for a piece of molded plastic, they need absolute certainty that it is genuine and that the box doesn't have a single microscopic dent.
And this brings us to what I thought was the most forward-looking, almost science fiction initiative discussed on the entire earnings call.
Here's where it gets really interesting. To solve this dual problem of trust and condition, Alliance launched a new initiative called Alliance Authentic.
And they integrated a technology they refer to as end-state authentic.
Basically, they are taking the concept of grading and encapsulation, which anyone who collects baseball cards or comic books is intimately familiar with.
Right, like PSA or CGC grading.
Exactly, but they are adapting it for vinyl records, movies, and toys.
The mechanism here is crucial to understand. They are encapsulating the item in a rigid, tamper-evident acrylic case while it is in an uncirculated state.
That specific phrasing matters.
It does. It means the item goes straight from the manufacturing line or the central warehouse vault directly into the protective case.
So it has never been shipped to a retail store, it has never sat on a shelf.
And it has never been handled by a browsing consumer. It is pristine.
But they go a step further than just putting it in a thick plastic box. They are embedding the case itself with an NFC chip, near-field communication.
So you can tap your smartphone against the case and it instantly pulls up a digital record.
Which creates a permanent digital product identity. The goal is to track the provenance, the ownership history, and guarantee the authenticity of that specific item throughout its entire physical lifespan.
It's brilliant.
I have to admit, though, when I first read about the NFC chip, my immediate thought was about security. Like, if I'm buying a highly valuable item, what stops a counterfeiter from just cloning the NFC chip and slapping it on a fake case? NFC technology is pretty common. We use it to tap our credit cards every day.
It's a vital security question. And the answer lies in how modern authentication architecture works.
Okay, walk us through it.
While the earnings call didn't dive into the deep cryptographic weeds, the industry standard for this, and what End-State essentially provides, is not a static chip.
A static chip meaning what, exactly?
A static NFC chip just broadcasts a simple text string, like a URL, which is trivial to clone. You could do it with an app on your phone right now.
Right.
But an authentication-grade NFC chip utilizes dynamic cryptography. Every time you tap it with your phone, the chip generates a unique, one-time cryptographic code based on a hidden internal key.
Oh, like a rolling code on a garage door opener or a two-factor authentication app.
Precisely. The chip sends that unique code to Alliance's centralized secure database. The server verifies the cryptography and then sends back the provenance data to your phone.
So even if someone clones it?
The counterfeiter might be able to clone the physical ID number of the chip, but they cannot extract the hidden cryptographic key required to generate the rolling codes.
That's fascinating. So if you tap a cloned fake, the server instantly recognizes the invalid cryptography and flags the item as counterfeit.
It effectively eliminates the man-in-the-middle attack in the secondary collectibles market.
That drastically changes the confidence a buyer has. And Alliance ran a proof of concept for this tech that honestly blew my mind.
The Record Store Day trial.
Yes. Let's go back to those Ozzy Osbourne and Hello Kitty figures. They made 2,000 of them for Record Store Day.
Right.
Out of that entire production run, they took exactly 30 units of each, just 30.
A tiny fraction.
They ran them through the Alliance Authentic process, encapsulated them in the uncirculated state, embedded the cryptographically secure NFC chips, and distributed them to a handful of top-tier stores.
Yeah, what happened?
Those 30 units hit the secondary market and were immediately selling for between $400 and $500 each.
The value creation there is astonishing.
It's pure alchemy. You are taking a piece of vinyl that costs maybe $2 or $3 to manufacture in an overseas factory.
Yeah.
You trap it in a specialized NFC-chipped case to cryptographically guarantee to the world that it is one of only 30 perfect, untouched specimens in existence. And you instantly manifest a $500 blue-chip historical asset out of thin air.
And if we connect this to the bigger picture, while the immediate margin on those 30 units is incredible, I'd argue the strategic pivot this represents for Alliance is the real story for investors.
How so?
Think about it. Historically, a distributor operates on a strict, one-time transactional basis.
Right. They buy the product from the studio, sell it to the retailer for a markup, and they are done.
Their financial relationship with that item ends forever. If that item becomes a massive hit and changes hands 20 times on eBay or StockX over the next decade, appreciating in value with every trade.
Alliance doesn't capture a single cent of that secondary market velocity.
They're completely locked out of the appreciation they helped create.
Man, that has to sting for a distributor.
It does. Furthermore, they have zero direct relationship with the final collector. They only know the retailer. But by integrating this end-state NFC technology, Alliance is attempting to transform from a passive, one-time distributor into an active platform that participates in the secondary resale market.
Because the chip ties the physical object back to their database.
Yes. By acting as the definitive source of authentication, they position themselves as the referee of the secondary market.
They solve the massive trust deficit for buyers.
And they protect the intellectual property of the licensors. The companies that actually own the rights to Hello Kitty or Ozzy Osbourne are protected from being diluted by counterfeits.
Because the licensors hate the fakes just as much as the collectors do.
Exactly. And most importantly, the CEO explicitly stated that this infrastructure is designed to support authenticated resale and direct engagement with collectors over time.
Oh, wow.
It opens the door to secondary market transaction fees, digital transfer fees, or highly targeted direct-to-consumer marketing. Because they now know exactly who holds the most valuable assets.
It's like they're turning every physical toy, vinyl record, or movie into a secure, interactive node on their own proprietary network.
The product itself becomes a platform.
And they aren't limiting this to toys either. The transcript mentioned they have cases ready for premium vinyl releases, DVDs, Blu-ray steelbooks, and even video games for platforms like PlayStation and Nintendo Switch.
They are essentially trying to establish a museum-grade archival standard for everyday pop culture items.
Which is such a wild concept when you pause to think about it. Archiving a mass-produced Nintendo Switch game like it's a first edition Hemingway novel.
But it works because the modern fandom is that intense. The emotional attachment to these properties is profound.
It really is. Now, we've talked about the tech and we've talked about the engineered scarcity. Both are brilliant, but you can have the most sophisticated engine in the world and it won't matter if you don't have premium fuel to run it.
Very true.
For a distribution company like Alliance, that fuel is their content pipeline and their exclusive studio partnerships.
Because you simply cannot build a sustainable billion-dollar distribution business solely on obscure indie titles or niche nostalgia.
Right.
The infrastructure required to run a logistics network of this scale requires massive, predictable volume. And that volume only comes from monolithic pop culture franchises.
And the earnings call highlighted some major victories on this front that really shore up their pipeline. First, they secured exclusive physical distribution rights with Paramount, an agreement that kicked off in 2025.
Huge win.
Then they layered on Amazon MGM Studios, which went active at the start of 2026. This fundamentally means if you are a retailer and you want to stock a physical copy of a movie from those massive studios, you must go through Alliance.
And management specifically called out an upcoming catalyst within that MGM deal, the movie adaptation of Project Hail Mary, based on the Andy Weir novel.
Oh, yeah, the guy who wrote The Martian.
Right. It's scheduled to hit physical media in August of 2026. And the executive team expects it to be their single biggest theatrical release across all of 2025 and 2026.
Securing the exclusive distribution rights to a guaranteed blockbuster of that magnitude gives Alliance immense asymmetrical leverage in their negotiations with retailers.
It absolutely does.
Let's talk about that leverage, because the movie side is just one pillar of this content pipeline. The real behemoth they discussed, the absolute 800-pound gorilla of the entertainment industry, is gaming.
Oh, yes.
Specifically, Grand Theft Auto 6.
The biggest entertainment property in the world right now.
Easily. The game is finally releasing in Q4, and Alliance is distributing the physical copies directly from the publisher Take-Two Interactive. But the genius here is that they aren't just moving the game discs.
They are leveraging their whole ecosystem.
Yes. They are simultaneously releasing a massive exclusive vinyl compilation soundtrack featuring over 20 A-list artists linked to the game.
This is the exact scenario where the cross-category dominance of Alliance becomes an insurmountable moat against competitors.
How do you mean?
Well, they aren't siloed as just a music distributor or just a video game wholesaler or just a toy vendor. They operate across the entire spectrum of physical entertainment.
And the CEO pointed out the retail synergy this creates, and it is so smart. Let's put ourselves in the shoes of a small, independent video game store owner for a second.
Okay, let's do it.
For your entire existence, you have sold consoles, controllers, and game discs. You have never stocked a vinyl record in your life. It's not your market.
No, completely outside your wheelhouse.
But suddenly, GTA 6, the biggest cultural entertainment launch of the decade, is happening. You know you were going to have a line of hundreds of people wrapped around your building on launch night. What are you going to do?
You're going to try to maximize every single customer in that line.
You are going to call Alliance and order 60 of those exclusive vinyl soundtracks to place right next to the register.
Because you need to capture as much of that massive, localized foot traffic as possible. An impulse buy on a $40 record while they're already spending $70 on the game.
Exactly. You are cross-pollinating gaming fans into vinyl collectors, and you are doing it all through one single purchase order with Alliance.
It perfectly illustrates why scale and consolidation matter so much in modern logistics. If you are a retailer preparing for a massive launch, or conversely, if you are a massive IP holder like Take-Two or Amazon MGM, the last thing you want is operational complexity.
You just want it to work.
Right. You do not want to manage a dozen different niche distributors for your ancillary products. You don't want to coordinate with one company for the vinyl soundtrack, a second company for the promotional toys, and a third company for the game discs. The logistical friction is just way too high.
You want one throat to choke if something goes wrong.
More diplomatically, you want one sophisticated partner capable of managing the sheer complexity of a synchronized global launch.
Fair enough.
Alliance has built the infrastructure to execute short, limited production runs for indie stores, massive pallet shipments for big box retailers, and targeted cross-category fulfillment all at the exact same time.
By simplifying the supply chain for the biggest IP holders on the planet, they make themselves an indispensable utility.
Indispensable is the perfect word.
If you own a massive franchise in 2026, Alliance's pitch is incredibly compelling. Give us the rights, and we will flawlessly monetize your hardcore fans across music, movies, toys, and games.
We'll handle the warehousing, the retail relationships, and the returns.
And we will even authenticate the premium items with microchips so your brand isn't diluted by counterfeiters. It's a full-stack physical media solution.
It really is.
But of course, to responsibly wrap up any deep dive into a corporate earnings call, we have to look past the narrative and look under the hood.
Always look at the bottom line.
We need to examine the balance sheet to ensure this whole operation is actually financially sound. Because, it is very easy to grow top-line revenue if you are slashing prices and spending wildly on marketing. But are they actually making sustainable money?
The financial metrics provided by the CFO, Amanda Necco, reflect a management team that is highly disciplined and focused on profitable growth, not just vanity metrics.
That's good to hear.
She provided some vital color on their margin profile. Their gross margins are stabilizing and actually expanded from 12.8% to 13.3% year to date.
Now, for anyone listening who doesn't live in spreadsheets, a 50 basis point increase, which is 0.5%, might sound completely trivial.
It sounds like a rounding error to most people.
Right. But in the wholesale distribution business, where you are doing hundreds of millions of dollars in sheer volume, a 0.5% increase in gross margin is massive.
It really is.
That drops millions of dollars straight to the bottom line, which explains that 78% jump in net income we talked about earlier.
I'm glad you contextualize that, because margin structure in distribution is highly sensitive. That 50 basis point expansion isn't happening by accident.
It's intentional.
It is the direct mathematical result of the mix improvement we discussed, selling fewer low-margin commodity CDs and more high-margin encapsulated collectibles, coupled with very strict pricing discipline across their catalog.
Makes total sense.
Furthermore, for a logistics company heavily reliant on inventory, their liquidity profile is exceptionally strong. They ended the quarter with $60 million in working capital and $56 million in availability on their revolving credit facility.
So they have plenty of cash and plenty of credit to maneuver. But honestly, when I read that, it immediately raised a red flag for me.
Really? Why?
It's a classic trap. A company has a great growth narrative, they build up a war chest of cash and credit, and then the management team gets bored or overly ambitious.
Ah, the empire building phase.
Exactly. They go on a massive spending spree. They start acquiring everything in sight, bloat the company with poorly integrated acquisitions, and completely lose the operational discipline that made them profitable in the first place. Are we seeing signs of reckless M&A here?
It is the perpetual risk for any public traded company with a strong balance sheet. The pressure to deploy capital just to show activity. But the management team explicitly addressed this risk head on during the Q&A portion of the call.
What did they say?
The CFO stated, point blank, "We are not pursuing growth for growth's sake." They outlined a very strict, highly targeted capital allocation strategy.
Right. From what I read, they are deploying capital selectively into areas with guaranteed modeled returns.
Yes.
They are funding exclusive inventory partnerships where the retail demand is already secured by contracts. And they're investing heavily in capital expenditures related to their tech infrastructure, specifically warehouse automation and the NFC tracking systems required to scale Alliance Authentic.
And regarding mergers and acquisitions, the CEO did acknowledge they are actively looking at opportunities and currently have several NDAs signed with potential targets.
Which is standard.
However, the critical caveat is what kind of targets they are pursuing. They are not looking to buy other generic distributors to simply add bulk revenue. They are laser focused on licensed product acquisitions that fundamentally drive higher margins.
Which brings us full circle back to the Handmade by Robots brand.
Exactly. The economics of owning the IP are vastly superior.
Break that down for us.
When Alliance acts as a distributor for a third-party toy company, they capture a small wholesale margin, maybe a few points.
Because they're just moving boxes.
Right. But when Alliance owns the Handmade by Robots brand entirely, they control the manufacturing costs, the licensing agreements, the retail pricing, and the entire go-to-market strategy.
Oh, so the gross profit margin on a toy they own outright is exponentially higher.
Exponentially. They are actively utilizing their M&A war chest to find targets that allow them to replicate that high-margin ownership model across different pop culture categories.
So it's a very calculated surgical approach to growth. They aren't building a sprawling, unmanageable empire. They are building a highly fortified, high-margin moat around physical pop culture.
That's a perfect summary of their strategy.
Which really brings us to the core takeaway of our deep dive today. If we look at the entire narrative arc of this earnings call, the conventional tech industry wisdom that physical media is a dead dinosaur industry waiting for the final meteor to hit is completely wrong.
It's completely backwards.
It hasn't died. It has evolved. It has transformed from a low-margin utility into a high-margin, premium collectible industry, and is being fueled by intense fandom, brilliantly engineered scarcity, and next-generation cryptographic authentication technology.
Alliance Entertainment has positioned itself right at the epicenter of this renaissance, profiting massively by being the indispensable link between the studios, the artists, the retailers, and the fans.
It's just a masterclass in adaptation.
It's a fascinating business case study, but I think this raises an important question that extends far beyond the financial metrics of Alliance Entertainment.
Oh, what's that?
It touches on the fundamental nature of how we are going to interact with culture in the future. We are accelerating toward a world where all our movies, our music, our books, and increasingly, our personal memories live entirely in the cloud.
Yeah.
They are ephemeral. They are subject to invisible algorithmic changes, and they can be easily deleted by a corporate licensing dispute that we have absolutely no control over.
Which is terrifying, honestly.
In that fully digital, highly transient landscape, will physical, authenticated objects eventually become the ultimate status symbol of the modern age? When absolutely everything in our lives is digital and infinitely reproducible, maybe the most rebellious, grounding thing you can do is hold something real, rare, and permanent in your hands.
Wow. That is a profound thought to leave on. The ultimate luxury of the future might just be permanence. Thank you for joining us on this deep dive. I hope this conversation completely changed how you look at that dusty CD shelf in your garage or that rack of vinyl at the local bookstore. The physical world isn't going anywhere. It's just getting a lot more valuable. Keep questioning the narrative, keep exploring, and we'll see you on the next one.